Hi, it's Michael Farr from Farr, Miller and Washington. Thanks for joining me again. I have a little bit of an update for you. There are enough headlines, and here we are in September, getting to the middle of the month, and lots to talk about and think about as we look towards year end. I try not to do too many of these, but the headlines demand what the headlines demand. As I look at the headlines this morning, as if it weren't enough to deal with Brexit, the trade talks with China, the upcoming Federal Reserve meeting this week, over the weekend we had and overnight we had a UAW, United Auto Workers, strike against General Motors. 48,000 GM workers are out on strike. They're not getting enough in terms of wages. We'll see how that plays out. And then, of course, there was a drone attack on Saudi Arabia's Abaqaiq oil field. Abaqaiq oil field represents about half of Saudi Arabia's oil production in general, and it was pretty much taken out. Now, that represents 5% of the world's global oil supply. So pretty much overnight, the world lost 5% of its supply. The Saudi government has said that they thought they'd bring almost a third of that production back online today. It's not quite happening that quickly. And in fact, Aramco, which is the big state-owned oil company that's been trying to go public for a while, may be delayed in going public and has suggested that they are much more cautious in their estimates about recovering some of that oil supply. So this changes the math, really. That's 5.7 million barrels per day of oil that were being produced out of those oil fields in Saudi Arabia. That changes the math. And it changes the math of supply and demand for the price of oil, and it went higher. It went higher by 10 or 11%. It's been a little bit higher than that. But essentially, a price per barrel now is over $60 a barrel. That's up about $5.50, 10 or 11% increase in the price per barrel of oil. If you're thinking about economics and you're thinking about a world that is growing slowly, the cost of energy just went up. It just became a little bit more expensive to grow. It became more expensive for airlines to fly. It will become more expensive for consumers around the world to buy a tank of gasoline or heating oil as winter comes to the northern hemisphere. So these are all sort of just a little additional headwinds. In addition to those higher costs, we have seen a vulnerable oil supply. It's very vulnerable. I mean, this was just done with drones. No people were involved. So we now have a much less stable Middle East. A less stable Middle East, a vulnerable oil supply will change the calculations that investors have to make when they think about investing in oil, and when corporations think about building or expanding around the world. Costs of energy, as they go into those forecasts, are going to go up. As you look at earnings forecasts for those companies, particularly in the transportation sector, profits are going to have to come down a little bit because fuel costs are going up. That less stable Middle East is tough to predict. What will that mean around the world? Will there be a military involvement? Will there be a war in the Middle East? How will that involve the United States? All of these things have me scratching my head and expecting to come in and see markets down 500 to 1,000 points this morning on the Dow Jones Industrial Average. None of that happened. The Dow Jones Industrial Average down 100 to 150 points only. As I just checked the levels on the Dow, it was still above 27,000. The S&P was 3,000. NASDAQ above 8,100, 8,150. Markets are taking this well in stride. I'm not sure why. You would expect interest rates to really fall as the demand for safe bonds increased. As I buy more bonds and I want to buy more bonds and more bonds, people on the selling side say, well, I'm going to pay you less interest. If everybody wants my bonds, I'm going to pay you less interest. So as bond prices rise, interest rates fall. The 10-year Treasury was up at about 1.9 something percent. It's now 1.86. It's gotten a little bit higher, but not dramatically. The 2-year, 1.77. Interesting that that yield curve inversion remains. 1.86 for the 10-year Treasury, 1.77 for the 2-year Treasury, 1.72 for the 5-year Treasury, 1.77, 1.72 for the 5-year. The 5-year is trading lower than the 2-year. 10-year still higher. And the 3-month is 1.96. If you want to make more money, if you want to get a better return in Treasuries than you can for 10 years, 5 years, or 2 years, buy the 3-month Treasury bill. Isn't that strange? That's what an inverted yield curve means. Doesn't really bode well for growth. What does it mean that markets are still up strongly for the year? S&P 500 is still up slightly over 20% for the year to date. The NASDAQ is up even higher. The NASDAQ has been losing ground versus the S&P in the recent couple of months here, as some of the more safe value stocks have been outperforming. There has been a general shift to more safe areas, but we haven't seen this bullish psychology, bullish market psychology, show the least bit of a chink yet. No matter what the president has tweeted, no matter what the Chinese have done, no matter what has happened in Brexit, stock prices have done this. They've gone higher. They continue to go higher. They're up 20% year to date. I didn't hear a single prognosticator at the beginning of the year suggest that markets would go up 20% this year, stocks go up 20%. None. They have. Earnings are up 5 or 6% this year. Everybody predicted slower earnings growth. That happened. So we have slower earnings growth and much higher stock returns. That means stocks have gotten more expensive over the course of this year. Things that are expensive can become more expensive as time goes on. But you can never forget, and I can never forget, that things are expensive and that this market is not falling at a rather vulnerable time with very vulnerable headlines from China, from Brexit, from 48,000 auto workers going out on strike, and 5% of the world's oil supply being removed overnight. Stocks are off 100 points. I mean, out of 27,000, that's not much, folks. It strikes me that the downside potential, the potential for more disappointment is much greater than the upside as I look at stocks and markets in general right now. So you have to know what you own. You have to know why you own them, and I'm going to really encourage you to focus on solid balance sheets and limited levels of debt and good operating companies. As I said, the market psychology has been robust, very bullish, no chink. That changes. There are 3 phases to market psychology. The first is denial. When markets start turning up, people remain bearish and they say, oh, well, but this won't last. And then it does last, and they go, well, okay, I guess this is a bull market. And then there's ebullience, where everybody just starts to party and says this is going to be great and don't worry about a thing. That ebullience party has been going on for a while. The Federal Reserve is going to meet this week, and everybody is expecting them to decrease interest rates by another quarter of a point. I don't think they should. I don't think it's necessary. GDP is growing. Unemployment is fine. I think they ought to save their powder. I think they ought to be data dependent. And I don't see, by the way, any big bang for the quarter of a point buck. Who's going to borrow any more money? How much more economic activity are you going to generate by taking that 10-year Treasury from 1.72% to 1.55%? 1.45%. I mean, How much? Who's going to borrow money? I don't get it. I understand everybody wants it, but I don't get it. I don't think it's necessary. And I think that wages are increasing and there are some green shoots out there, and this economy is not bad. And I have not heard an economist yet say that they have to lower rates now and that we're in big trouble, because that's going to solve the problem. My friend Mohammed El-Arian had suggested, in fact, that there should be a coordination from the fiscal side of government, fiscal policy, tax policy, that sort of stimulus, but that the central banks have painted themselves, or have been painted into a corner, and they're not getting the bang for the buck. I think his observation is exactly correct. And I would love to see our Federal Reserve stay on the sidelines. Don't think they will, but I'd love to see it. What should you be thinking? Once again, look at your portfolios, and if we can help you at Farr Miller in Washington, we'd be delighted. Please give us a call. Please send me an email, mfarr@farmiller.com. We'd be happy to help. So, for all of the headlines that are swirling around, make sure that you keep your head while others lose theirs. And if things don't make sense to you, as they often don't in the marketplace and certainly in the news headlines, whether you're a devout watcher of CNN or Fox, somewhere out there there's a whole lot of noise, and you need to focus on your portfolio and what's going to make sense for you and your family for the long term. Those are the folks we're here to help at Farr Miller in Washington. Please let us know if we can help you. In Washington, D.C., thanks for tuning in and listening to me again. Hope we can be helpful. I'm Michael Farr.